Joining us right now, former Reagan Council of Economic Advisors Chairman and former Jeb Bush Economic Senior Advisor, Marty Feldstein. Marty, always good to see you.
Good to be with you.
Thanks so much for joining us. And we want to kick it off with this op-ed that you wrote in the Journal on the 17th in May as to why the Fed's inflation fixation needs to be ended.
Well, it's not that they're paying too much attention to inflation. It's that they have this target, and their target is 2%. And by the way they counted, they're now at 1.6. So their argument is we have to keep interest rates super low to get from 1.6 to 2. Who cares?
Yeah, so you think the Fed should be raising rates?
I certainly do.
And you think we'll see that in June?
I hope so. I think they've now sent enough signals so they're not going to be scaring the market or surprising the market if they actually move.
Let me get John Williams' comment in here, because on Sunday Morning Futures this weekend, the president of the Federal Reserve of San Francisco, John Williams, talked about raising rates going into an election year. Here's his answer to that.
We've proven over and over again that we can act in presidential election years, taking controversial policy decisions. We've done that before. We'll do it again. We are about as apolitical as you can imagine, just focused on our goals.
So in other words, nothing's off the table. You could see rates going higher than in September, right before the election.
Sure.
Or October.
It will be based on the data, based on our analysis. I mean, we're really focused on the economy, what the data is telling us, and how to best achieve our goals.
And Marty, when he focuses on the economy, he said in his part of the world, and that's obviously San Francisco, it's booming.
It's booming in the U.S. because of Fed policy. The Fed has brought us back to full employment.
But, Marty, you say the Fed should be raising rates. What's the urgency when inflation has been below this 2% goal for almost 4 years now?
That's the issue. He says
they're fixated on it. Is barely growing.
So there are two reasons. One is that inflation is rising. If you look at CPI, which is what most people look at, the CPI, the core CPI,
the Consumer Price Index?
Consumer Price Index, take out energy, is up 2.1% relative to a year ago. If you went back a year, it was 1.8, so it's rising and rising faster, as you'd expect in a full employment economy. So you want to be ahead of the curve on that. But the other thing is these super low interest rates that we've now had are, I think, distorting asset prices all across the board.
Well, one of the things that will be distorted if the Fed raises rates aggressively is the dollar. We're going to see a much stronger dollar. What do you say to American manufacturers who get hurt by that?
You know, the dollar will move wherever the dollar moves, and they will be gainers and losers in that process. American consumers will be gainers. They'll spend some of that money buying manufactured products made in America. So I don't think we should allow that to distort what is really the risky situation in which very low interest rates are driving up commercial real estate and equity prices and other things.
You were an advisor to Jeb Bush. If you endorsed Donald Trump?
I have not endorsed anybody.
Are you gonna?
I don't see any need for me to endorse anybody at this point.
So Trump has said that tax rates on the wealthy are likely to go up. Is that a Republican, part of the new Republican platform?
Well, wait a minute. He said that his tax plans are going to go down, but they would, after being negotiated with Congress, they would go up from his lowered level. So he did say that he's going to lower taxes overall.
So if you can figure out what the bottom line is on that, that's pretty good.
What does the economy do under a Trump presidency, in your view, given his economic plan?
I don't think we know his economic plan. I think my hope is that we will see cuts in the corporate rate, that we will see moving to a territorial system.
Well, that's what he said, 15% corporate rate.
From the beginning, he's had a plan since last September calling for 15% corporate tax rate.
Yeah, well, 15 will be hard to get through Congress, but as he said, he's a good negotiator, and we'll see what comes out of that negotiation. But even if it came down from 35, remember that's where it is now, 35. Even if it came down to 25, that would get us in line with the rest of the industrial world.
Would that create euphoria? Would that be a growth catalyst?
That would be certainly that, plus moving to a territorial system, meaning that we will not penalize American companies who earn profits abroad, and right now can only bring it back by paying against a tax rate of 35%.
Real quick, Marty, I know you're just back from Japan. Why have negative interest rates failed?
Well, they scared the Japanese investors. They're hurting the Japanese banks and the Japanese insurance companies. So they're not really accomplishing anything for the Japanese. And they seemed like a desperate act on the part of the central bank that's been promising 2% inflation year after year and not coming close.
Yeah. Marty, always a pleasure. Thanks
Great
so
being
much.
with you.
Great insights, as always, from Marty Feldstein there.